The financial crisis of 2008 is considered one of the most significant economic events in modern history, with far-reaching impacts on the United States and global economies. The crisis began in the housing market, where a bubble had been building for several years. This bubble was fueled by a combination of factors, including low interest rates, lax lending standards, and the development of complex financial instruments like mortgage-backed securities. As the housing market began to cool in 2006 and 2007, many homeowners found themselves underwater on their mortgages, meaning they owed more than their homes were worth. This led to a wave of defaults and foreclosures, which in turn caused a ripple effect throughout the financial system. The banks and other financial institutions that had invested heavily in mortgage-backed securities suffered significant losses, which triggered a broader crisis of confidence in the financial sector. The crisis reached a boiling point in the fall of 2008, when Lehman Brothers, a major investment bank, filed for bankruptcy. This sent shockwaves through the financial system, and credit markets froze up as investors and institutions panicked. The U.S. government responded with a series of emergency measures aimed at stabilizing the financial system, including the Troubled Asset Relief Program, TARP, which authorized the government to purchase troubled assets from banks and other financial institutions. In addition to TARP, the government also implemented a range of other policies aimed at addressing the underlying causes of the crisis. These included regulatory reforms, such as the Dodd-Frank Wall Street Reform and Consumer Protection Act, which aimed to improve oversight of the financial sector and prevent a similar crisis from occurring in the future. The Federal Reserve also implemented a range of monetary policy measures, including cutting interest rates to historic lows and implementing a program of quantitative easing, in which the central bank purchased large amounts of treasury bonds and mortgage-backed securities to inject liquidity into the financial system. Overall, the financial crisis of 2008 was a complex and multifaceted event that required a range of policy responses from the government and central bank. While the crisis caused significant economic pain and disruption in the short term, many experts believe that the policy response ultimately helped to stabilize the financial system and prevent a more severe downturn.